If I had to start investing again today from absolute zero, no portfolio, no savings invested, just a blank slate, this is exactly how I would do it. I've been investing for years, and trust me, I made plenty of rookie mistakes when I first. And if I could go back to the beginning, there are several things I would do very differently. So today, I want to walk you through the 7 exact steps I would follow if I were starting from scratch. By the end of this, you'll know how to invest with confidence and avoid the traps that most beginners fall in. Because the truth is, investing isn't about luck or guessing the next big stock. It's about building a simple system that works for you over the long term. And the very first thing I would focus on has nothing to do with buying stocks. Step 1 is getting your financial house in order. You might be surprised to learn that millions of people can't even cover a small emergency expense without borrowing. Life happens unexpectedly, and if you're not prepared, those surprises can destroy your investment. If something goes wrong and you don't have cash saved, you may have to sell your investments at the worst possible time. When I first started investing, I felt pressure to catch up with people who already seemed far ahead. That pressure can make you rush into investing money you really can't afford to lose. And when the market drops, it's incredibly easy to panic and sell too early. That's why, if I were starting today, I wouldn't invest a single dollar until my financial basics were. The first thing I would do is pay off any high-interest debt, like credit cards or personal loans. Investing while carrying expensive debt is like filling a container that has a hole in the bottom. When your debt is charging 20 to 40% interest, it's almost impossible for investments to grow faster than that. So the first rule I would follow is simple. Eliminate high-interest debt before even thinking about investing. The second thing I would do before investing is build a solid emergency fund. Ideally, I would save enough cash to cover 3 to 6 months. That emergency fund acts like a financial shock absorber when life throws unexpected problems your way. So if my car breaks down or something expensive happens, I don't have to touch my investments. Having this safety net would also help me sleep better at night and make better decisions as an investor. The third thing I would make sure of is that my income and spending are stable. I would want to know exactly how much money I can safely invest every single month, because investing should never put pressure on your daily life. When your finances are stable, market drops feel much less scary, and that allows time to do the heavy lifting for your investment. Once my financial foundation was solid, the next step would be defining exactly what I'm investing. Many people start investing without actually knowing what their goal is. But investing becomes much easier when you have a clear destination. I would ask myself a simple question, because your goals determine how you should invest your money. If I needed the money within the next 5 years, I would keep it in cash or savings. That's because investments can move up and down quite a lot in the short term. But if my goal was more than 5 years away, that's where investing really shines. The longer your money stays invested, the more time it has to grow. And over long periods of time, investments have historically outperformed keeping money in cash. Once I knew my goals and timeline, the next step would be choosing the right investment account. This is actually where many beginners get stuck. There are so many options that it's easy to fall into analysis. You can spend hours researching accounts and still never actually start investing. But the truth is, opening your first investment account is much simpler than most people. In most cases, you can open an investment account in just a few minutes. If I were employed, the first place I would look is my workplace retirement plan. Many employers actually contribute money to your retirement, and when someone is literally adding free money to your investments, it's something you should absolutely take advantage of. The only downside is that you usually can't access that money until. If I was self-employed, I would look into a private retirement. These accounts often give you tax advantages while you save for the future. Paying less tax on your investment gains can make a huge difference over time. That's why I would always look for accounts that protect my investment growth from taxes. Now, once my account is ready, this is where many people think they need a lot of money. But the truth is, you don't need thousands of dollars to start investing. What matters far more than the amount you start with is consistency. Even small monthly investments can grow into something surprisingly large. That's because of something incredibly powerful called compound growth. Over the years, your investments start earning returns, and then those returns start earning their own returns. At the beginning, investment growth feels slow and almost invisible. In fact, during the first few years, it can even feel like nothing is happening. But the longer you stay invested, the faster compound growth starts working in your favor. It's like a snowball rolling downhill, slowly building momentum as it grows. That's why consistency matters more than trying to invest huge amounts all at once. The next step I would focus on is diversification. Think of diversification like building a balanced diet. You wouldn't eat only one type of food every day and expect. The same idea applies to investing. If your entire portfolio depends on just one company or one industry, you're taking a huge risk. Diversification simply means spreading your money across many investments. That way, if one area struggles, the others can help balance. If I were starting today, I wouldn't try to pick individual winning stocks. Instead, I would focus on investing in index funds. Index funds allow you to invest in many companies all at once with a single investment. For example, an index fund tracking the S&P 500 gives exposure to hundreds of the largest companies. This approach reduces risk and makes investing much simpler. Some investments will perform poorly, but others will perform extremely well. Over time, the winners tend to outweigh the losers, and that balance is what allows your wealth to grow steadily without constant stress. The next step I would focus on is automating my investment. Instead of deciding every month whether to invest, I would set up an automatic transfer. Right after payday, a portion of my income would automatically go straight into investments. This system makes sure the money gets invested before I have the chance to spend. Automation removes the need to constantly think about when to invest. Many people waste time trying to find the perfect moment to invest. But the reality is that consistent investing usually beats trying to time the market. Automation protects you from your own emotions. Interestingly, the investors who check their portfolios the least often perform the best. Because successful investing is often about doing less. The final lesson I would focus on is learning to stay calm when the market drops. Market crashes can feel terrifying when you see your portfolio losing value. But history shows that the stock market has recovered from every major crash. Every time the market falls, it eventually climbs higher again. When you zoom out and look at decades of data, those scary drops look much smaller. The biggest mistake investors make is panic selling during market downturns. Patience is one of the most powerful advantages an investor can have. And when you've prepared properly, it becomes much easier to stay calm during those moments. Because investing is not about short-term wins, it's about staying in the game for the long run. And the investors who stay patient are usually the ones who benefit the most in the end. One thing I've learned over time is that market drops are a normal part of investing. Even though the market experiences crashes, the long-term trend has historically moved upward. The problem is that many investors quit during those difficult moments. But the people who stay invested are usually the ones who benefit the most. So, if I was starting from scratch today, these are the exact steps I would. First, I would make sure my financial foundation is strong. That means paying off high-interest debt and building a solid emergency fund. Second, I would define my goals and understand my investment timeline. Third, I would open the right type of investment account. Fourth, I would start small but invest consistently. Fifth, I would diversify my investments to reduce unnecessary risk. Sixth, I would automate my investing so the process runs without constant decisions. And finally, I would train myself to stay calm during market downturns. Because successful investing is not about being perfect. You will make mistakes along the way, and that's completely normal. What matters most is staying consistent and continuing to learn. The earlier you start, the more powerful time becomes for your investing is really a long journey, not a quick sprint. And the people who stay patient during that journey are the ones who build real wealth. If I was starting from zero today, I would follow these simple steps and focus on the long term.